Good Saturday morning, everyone. And it's been a while since we've done a weekend video, so now's as good a time as any. Welcome. Thanks for watching. As always, if you enjoy the video, which I hope you do, please give me a thumbs up on YouTube. If you don't enjoy the video, my apologies. I'm always open to constructive criticism. That's where you say, I wish you covered things like A, B, and C instead of X, Y, and Z, rather than someone saying to me, you're an idiot or you're an imbecile. That doesn't really help too much. In any case, so today, thanks again for spending some time with me. I'm going to talk about what am I talking about today? Let's talk about the pullback. Actually, I may do two videos today because there's a pullback and then there's another topic I want to mention. Let's talk about the pullback. Let's talk about what's going on in the economy, when the pullback might end, what to do now, what else we're looking for, etc. So let me hop right in. As you know, because maybe you don't know. So I've been staunchly and strongly bullish from end of last September through almost the end of July. Any bit of weakness, I pounded the table to buy, including that bout of weakness related to those three banks going under in March. I was absolutely certain it wasn't 2008 all over again. I did not think it was a banking crisis. I thought it was three outlier banks at the fringe doing things a different way, the wrong way, a manipulated way. Pick your poison, doesn't matter. I wasn't worried about it. I thought it was another opportunity to buy. And then the market just kind of melted up from there. So we got into July, and most people know that I like to look at extremes. Look for points where the masses are on one side and you got to be on the other side. Just taking the opposite side of what your neighbor thinks isn't being contrarian. It's going opposite your neighbor, who may be right or wrong. We don't know that. But when the masses all line up in one direction, market usually does something different. It doesn't normally reward the majority. So we got to the end of July. The bull market does need, and all bull markets need, people to accept it and invest money along the way that fuels it higher. But when you get mass acceptance of something or mass denial of something, you're usually at some kind of extreme. End of July, there are some small cracks forming in the stock market, and I thought that probably the rally pauses, mild pullback, you need a little refresh. That's okay. Throw on top of that, the calendar did not work favorably for the bulls. Seasonal trends and seasonality are best described as tailwinds and headwinds. It's very hard to make investment decisions just based on calendar tendencies because there's no way to know when you're wrong. The calendar doesn't work every single year the same way. When we look at calendar and seasonal tendencies, we look at large periods of data and we compute and create an average. So you know that in a midterm election year like last year, I kept saying, look, we're likely to have a bottom. There are two likely periods for a bottom. One was March, one was October, based on seasonal trends. And the bottom obviously happened in October. So right now, we're in a seasonally, I wouldn't say it's that negative. I think they blow it out of proportion. This is a seasonally weak period. It usually starts in a pre-election year. Mid-late July, there's a summer peak in the market, and then there's a fall low, and then we rally into Q1 from there. It is not an exact science. So when you see people average all these dates together and they come up with, September 15th at 12 o'clock, great. That's just an average of what's happened in the past, but each year is going to be a little different. Generally speaking, in a pre-election year, we'll see a low either the end of August or the end of September, or perhaps both. There's no perfect way to play it. What I've said lately, I think I said it on TV with Fox the other day. I can't remember, but the Fed is going to Jackson Hole on, when are they going? this week, Friday. I think Powell speaks Friday. In any case, oftentimes when you've got a strong trend into an important Fed meeting, that acts as a peak or a trough. So if the market sells off, which it has been doing, into the Fed meeting, we likely rally out of the Fed meeting, plus or minus a few days. If the market was ripping higher into Powell speaking, we likely begin to pull back post-Fed meeting. Well, we already know the market's down 5+%. I wrote it on the blog the other day. I've been waiting for, since I went to pullback mode in end of July, I said in a bull market, there are many lines in the sand, but the first line to get me really interested is when we're down 5%. Nothing magical, nothing special, but in a bull market, that's usually a good time to make your shopping list, prune, plant, and get ready for the next rally. This, again, we could go down 10. I don't think so. I've said all along this is going to be a single-digit decline, and I'm sticking with it. In a perfect world, what would happen is we go down, this, we put in a low, this, I keep looking to my left because my counter's on the wall, but we would put some kind of low in around the Fed meeting. We would rally into early mid-September. We put in another low in late September, and then we are off to the races into January. That's the perfect world. Does the market forces always cooperate with my perfect world? No. But that's what I think I'd look at in the surface. Low comes now, we rally, another low comes, we're off to the races into January. Interesting this week, as the markets declined, the media is looking for more negative forces. So I think you may have seen it, but Michael Burry, who was the inspiration behind, do I have the book? No, I gave it away. The Big Short. Christian Bale played Michael Burry, who had an amazingly, that once in a generation call in the great financial crisis. He was on the opposite side of the mortgage industry. So he made, I can't remember the number. It was some unfathomable number in a short period of time. Similar to what John Paulson did, the great hedge fund manager. Both were super high profile success stories. Interestingly, Paulson ever since that was like his call of his lifetime, and he's not done well ever since. It's hard to top a generational call and trade like he did in the great financial crisis. Burry has had a little more success, but not overwhelming success. He came out this week and said, I am putting 90% of my portfolio, and I haven't seen proof of this yet, but he says he's lining up 90% of his portfolio to buy options that positions for the stock market to crash. Well, when you use the word crash, we've had one crash in the modern investing era, 1987, October 19th, 1987. That's the only crash of the modern investing era. People called 2008 a crash. Folks, 08 was not a crash. 2011 was not a crash. 2015, 16 were not crashes. COVID was not a crash. Crashes happen in a period of 2 or 3 days. It's like a waterfall. You go over the top and it accelerates like a snowball right to the bottom in straight line fashion. No intervening rallies. That's a crash. 1929, 1987, those were crashes. So when you use the word crash, media gives you a lot of publicity. So Burry came out and said that. A lot of people, I've heard a lot of folks commented. They say to me, Burry and Warren Buffett are looking for crashes. So first, facts not in evidence. Burry, yes. Warren Buffett's never, ever, 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 ever said, I'm looking for the stock market to crash. Warren Buffett typically only makes major investments when he's in a position of strength. He has an unusually high, a couple of $100 billion in cash. It's not because he hopes there's a crash or looks for a crash, because he only buys tremendous values. In 08, everybody came to Warren because they needed him to bail them out. COVID, he was very disappointed. Markets unraveling March of 2020. As I understand it, Buffett is making his shopping list. and looking for a place to invest, $100 billion. I thought he should have bought a big stake in Boeing. That was the perfect Buffett stock, but he didn't. Then the government came in with all the with the PPP and with the savings of the bond market and all those programs, and that happened so quickly that people said, "I don't need Warren Buffett because you pay him an arm and a leg through the nose for his rescue." The government rescued everybody. In any case, we're seeing and hearing about major plays to the downside. And look, Michael Burry is a really brilliant guy. He had a generational call that will go down in history. I don't see the market unraveling like he does. Could I be wrong? Sure. I'm wrong every day, week, month, quarter, year. That's just how it is. In his case, if there is a crash, which again, I don't see it now, there would have to be a process to develop that. And I don't think we're there right now. But we'll see. I take it one day at a time. I think we are going to bottom, and then we're going to run Q4 right into January. Burry aside, the bears from last June right through now, which is August 19th, bears have been out in full force. The problem with the bearish side is they keep moving the goalposts, changing their narratives. New spin. First, last year it was inflation's out of control, blah, 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 Armageddon, blah, 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 blah. It didn't work out. Then it was, okay, inflation started to roll over, but interest rates are going up, 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 up. That's really bad, blah, blah, Armageddon, we're going down, blah, blah, blah. Okay, and then rates kind of leveled off on anything the Fed doesn't control. And then it was, well, all these rates of inflation are leading to recession. Everybody came in looking for recession. Well, guess what? Didn't happen. Market didn't cooperate. There's no recession yet. Then the bears said, all right, well, rates are going up again. Let's go back to the rates narrative. And then recently it was, okay, now what's going to happen is even though rates are high, inflation's going to go back up again. And then the other day it was, no. Forget about that. It's now China. No. I mean, pick your side of the argument. I don't care what your argument is. Pick your side, back it up. Let's have a conversation. End of last September, I was banging on the table. I was on every TV show I could find because I thought a new bull market was beginning. And I had one thesis. It wasn't like, okay, well, if rates go up, then if rates go down, and if the economy goes up and the economy goes down, pick your thesis, stand by it. And when you're wrong, just fuck, you're wrong. I'm wrong all the time. I'm wrong, move on, let's go next. So we're in this pullback. I think we trough somewhere around the Fed meeting on the 25th. We rally, we go down, we could go down again end of September. Now is kind of the time to make your shopping list. Let me say this. When people say, why are you so sure there's not recession right around the corner? First, a year ago, when we had back-to-back negative quarters GDP, I was emphatic. I was all over the place saying the Republicans and Democrats have made this political. Back-to-back negative quarters GDP growth is not a recession. Only the National Bureau of Economic Research, they're the law. They're the final arbiter of when there's recession. What happened last year were some statistical anomalies that immediately repaired themselves. We didn't have the economic weakness. So what do I think? Well, I'm going to show you. Because I'm going to show you what's not happening. In a recession, what does well? Well, we know defensive things like consumer staples. So here's the consumer staples sector. Look what's happening the last month. Consumer staples are down the right side of the page. That does not spell imminent recession. Let's look at utilities. I mean, utilities are death. They look just awful, having tried unsuccessfully to trade them a few times. So, what is going on with the screen? 1 second. There we go. So utilities do not look good. And part of that, folks, is that when rates go up, they become competition for utilities because utility people, a lot of people buy for yield. You do not see utilities go down, down, down into recession. I'll throw on telecom because they also have big yields. We know about the problems with AT&T and Verizon and the lead wires, but you don't see telecom rallying. Like, you're just not seeing traditional recession sectors rallying. Now I'll go a step further. Granted, we're in a pullback. I agree with you. Before you push back. But look at what industrials have been doing since the October low. I mean, they're going right up, right up. If we're on the verge of recession, the industrials are not rallying like that. You want to know about materials? Not as strong because there's a lot with the international and emerging markets. But look, materials remain, they made a new high in July. That's not what you see if you're on the verge of recession. I'm sorry. And then, the transportation sector. Come on. Who's going to argue that we're having recession when the transports made a new high last month? This is not what happens during recession. Not. So let me stop sharing this for a minute. Okay. I think you get my point. During this pullback, a lot has pulled back. A lot has gone down. This is more of a market event than it is an economic event. Pullback's going to end, in my view, and we're going to rally, blah, 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 blah. If you have this thing, this irksome thing inside you saying, Paul, I think you're too positive, you're too bullish, you're too happy about this, and something's bothering me, I don't know what it is. I tell you to do this, because I would tell you that keep an eye on the dollar index. The currency market, the currency market's the biggest, then comes the bond market, then comes the equity market. A lot happens in currency. So you look, the dollar started to go down significantly. There's your equity stock market bottom was over here. The dollar had already peaked. And then the dollar going down was a tailwind for stocks. Not always, just most of the time. So we're looking to see extreme moves in currencies to tell us that something else is going on. So right now, we're really, between, 99 and 105, the dollar is in some kind of range. If we start getting the dollar collapsing, the dollar did collapse ahead of the stock market crash. And on the day of the crash, James Baker, the Secretary of the Treasury, said, we're not going to defend the dollar, we're going to let it float. And that was one of the contributors to the crash. But the real one was Alan Greenspan coming in and then going nuts with interest rates. As you know, I think he's the worst Fed chair of all time. I'll stop there before I get into a rant. Watch the currency market. If the currency market really has dislocations and goes crazy in either direction, that's when events happen. Typically not when currencies are tame. All right. And let me move to the stock market. Why not, right? If you read the blog on Friday, yes, Friday. I showed this on Friday, but obviously before the market opened. Let me give you a better view. So the red line is the down 5% line. The market closed down 5% from its recent peak right there. That's a 5% decline. Nothing magical, nothing mystical, just that we're down 5% from the peak. The blue lines are just prior peaks in the S&P. So you'll see here, the first blue line equals the August peak from last year. The second blue line equals the peak from February. Now, again, just points to keep in mind on the chart. The market has reached the first point where I'm keenly interested in committing money. and the next point will be the two blue lines. There's nothing scientific when I said, we're going to bottom somewhere around here. Oh, it's an old diagram that I did with a client. We bottom, we rally, we make another low, all within the context of 4,350 to 4,200. Yes, I know it's a big band, but that's all I can give you right now. And then I think we're going to new highs into December, January. That's my thinking. Yes, I still like tech. Before somebody asks me, I do. If we look at what's going on in the most simplistic terms, I'm not going to put up how each sector is performing against the S&P, but I could do that in the blog. I love semis. I've loved them all year, and I still like semis. I think they are going to lead the next rally. So there's one. I like semis, and in tech, I go to internet stocks next. There's nothing wrong with internet stocks as well. Communication services had a great run. We sold it last week. We sold our second piece last week. We've owned it well, and I've been happy about that. So you've got semis and internet stocks look good. The old ARC, which I've sadly owned too long. I mean, that's a 20% decline, folks. Yeah, that'll be on my shopping list as well. On the banking side, banks, I'm always torn on banks. They've pulled right back to where they're supposed to pull back to. This is normal, expected, and routine. So if you're someone like me and you give the banks a shot, I have a really tight stop to know if I'm wrong. Maybe it's 37. I'm just speculating right now. I haven't done any work on it yet, but I'm not going to give it a ton of room. I'm not going to let banks unravel to 30. There's a window in here that they could decline to. So we've got two blue lines that tell me where to look to buy banks, somewhere in between where it is right now and 37 and change. Over closes at 37. Listen, I know I'm wrong. Lick your wounds, say you're wrong, and move on. The insurance stocks, I don't have anything comment-wise there. Consumer discretionary, if the economy stays okay, you'll see it right here. So if you want to watch the economy, watch consumer discretionary and watch the consumer staples. Against each other, you want the line going up from lower left to upper right. That tells you no recession. When it's the opposite and it's declining, it doesn't say we're having a recession. It just means that staples are getting some love, and recession is something to look out for. Oh, you know what I wanted to mention? It's so funny. If you read my blog on Friday about COVID and me buying an apartment in Manhattan, which we never ended up doing because my wife hates Manhattan, coming into the year, the home builders, they bottomed last June. And that was one of the sectors I said, boy, that's so interesting because we know how bad housing is. We know what mortgage rates are doing, but yet the home building stocks bottomed last June. I think I bought, in our unloved gems, I think I bought Rocket Mortgage. I think I bought it last June as well. Not 100% sure. Doesn't matter. It's the same premise in that what's supposed to happen economically and fundamentally, the home building stock should have been decimated. But look, they went right to new highs. They defied all logic. Everyone was on one side of the trade. The other side of the trade happened. I'll look at healthcare. I have no opinion there. Biotech, it was one of my sectors of the year. It has not rewarded me. We've had large holdings in biotechs, and then we reduced them down to nothing, and now we've got a modest position, but I'm still stalking biotech. I don't love them yet like I do tech. And I already mentioned, industrials look good. How do you argue with that? They're pulling back from a new high. Same thing with transportation, pulling back from a new high. Energy, I have not been on all year. Although I do think if we can get a deeper pullback, I do like energy again. And then we already covered staples do not look good. Utilities do not look good. Real estate does not look good. REITs, commercial REITs. So that's where I am right now. I've got to do some more work on some individual names, but that's where we are. And I think what I'll do is I wanted to talk about 0-day options, which I did on Fox Business on Thursday. I think it certainly warrants some attention. So I'll try to do another video this week, and we'll have a conversation about that. I think I'll close this. I do think 0-day options are the next weapons of mass destruction in the markets. I'm not a fan. I don't trade them, for full disclosure. Will I ever? I don't know, but I don't right now. Do I understand them? Yes. I think they're weapons of mass destruction for the average person. But they're out and tradable, and you got to deal with it. But they're having a very high influence and impact in the markets. We will talk about that next time. I'll have to make a mental note to do a video. So I thank you for watching. I always welcome questions, comments, concerns. You can email me, Paul@InvestForTomorrow, and you're always welcome to hop on my calendar, grab some time on my calendar, or call the office. Thank you for your time. If you like what you saw, please give me a thumbs up on YouTube, and we'll be back with you soon. Take care. Bye-bye.